And there is paint drying and there is grass growing in the stock market today, all in good working order, it would seem, but absolutely no major headway being made after what was a very interesting Friday session, and a session that really worked just about as we discussed it here when last we met. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And when we last spoke on Thursday, we discussed how the inflation component in the University of Michigan consumer confidence data carried the risk of a spook for Wall Street, and it certainly did that. We'll take a look in just a moment why and how it happened, because it was basically exactly what we said. And that set up a very interesting set of circumstances for this week, because, of course, what we are looking at is a week stuffed to the gills with inputs into monetary policy expectations. And so if the market is going to be this jumpy around that kind of a story coming out of what is essentially a tertiary inflation indicator, it could get very spicy when the primary indicators hit the tape. And so that's what we're going to focus on here today. We're going to look at the week ahead. We're going to see what it was in the consumer confidence data that, as we expected, got everybody in a huff. And then we'll take a look at what's coming up this week and how that kind of a jittery backdrop might have scope to continue. So let's first consider the data. When we looked at this on Thursday, we said, look, there is virtually no way, by the University of Michigan's own reckoning, that consumers being polled for this confidence survey haven't noticed that inflation, one measure after another, PCE, CPI, ECI, PPI, you name it, registered north of expectations in the month of April, and of course, leading into it as well. The dispersion was a little bit less concentrated. In April, everything seemed to come together. Because indeed, the University of Michigan put out a report in May that told us what it is that people care about when they look at inflation data and where they get their information. And it was overwhelmingly from mainstream news, both regular outlets and online outlets. And that, of course, suggested, well, if people are not getting their inflation information from personal experience, that was by far the most modest part of the mix. Overwhelmingly, a very small percentage of people get their inflation expectations from what they actually see out in the world as they themselves interact with the price structure. Mostly they get it from the news reporting it. And if that's the case, surely they didn't miss the headlines for 3 months saying inflation numbers are beating forecasts, and in April, a crescendo of those kinds of headlines. And we also can see that sentiment has been steadily improving since about the middle of 2022. And the turn came just about a month after we crested on 1-year inflation expectations in that very same consumer confidence survey. This is not surprising. If inflation is the primary worry for consumers and they begin to mark down their inflation expectations, a trend that we've seen basically uninterrupted here since about the middle of 2022, we can see here the trend is down. Despite some of these errant spikes here, they continue to set lower lows, and sentiment improves in tandem. Well, then if we were going to get inflation expectations jump, sentiment was likely to deteriorate. And the likelihood that inflation expectations jumped seems significant given what the news has been saying and where these survey respondents apparently get their data points, where they get their bearings, as it were. And so, not surprisingly, inflation expectations jumped. The expectation that the markets had, the forecasts that were out there at the baseline, thought that we were going to stay well within the 3.1, 3.2 to 2.9 range that we'd been carving out since the beginning of the year. As it happened, we jumped to 3.5%. Not surprisingly, against that back story, sentiment cracked lower. This is the same thing that happened here. It's the same thing that happened here. Now, the trend in sentiment, by the way, is still up. But the response from markets was unmistakable. The moment this data came out, stocks retreated from the highs, the dollar rose from its lows, there was retreat in metals, and there was a turn in bonds. On the dime, across every major asset with sensitivity to the Fed policy outlook, which is to say, almost everything. And that, of course, sets an interesting backdrop for the week ahead, because what this basically means is that the market is still on pins and needles around what the Fed is going to do with rate cuts this year and whether inflation is going to be sticky. Well, here's the baseline where we find ourselves. At this point, the market has slightly edged into a hawkish direction over the past week. In the immediate wake of the Fed, we were looking at about 38 basis points, and now we're into 34. That seems like only a very small change, just 4 basis points. But it actually makes all the difference. Notice, once we started to get into this territory, stocks stalled. And they stalled exactly at the point where they started to break down at the beginning of last month, around this very same story. What happened at the beginning of April? Well, the Fed came out at the end of March and said, we still think there's going to be 3 rate cuts this year. By the time they did this, the market was already on the other side. They were already saying, no, maybe fewer. And then, of course, we got hot inflation data that nudged us from 3 closer to 1.5. And once the market got deep on the hawkish side of the Fed, stocks cracked lower. We are back to that point here because, of course, what have we been seeing recently? Soft U.S. jobs data and a Fed that said, yes, we probably aren't going to have room to do as many cuts as we thought, but we think policy is sufficiently restrictive or going to become sufficiently restrictive at these levels, which is to say we don't need to hike anymore, most likely. And we think that things are going to develop such that we might still have room to cut. So the Fed opted for kind of accepting that the data has shifted expectations and that their March forecast probably hasn't aged well, but also that they're adopting the most dovish version of that admission. Rather than saying, inflation is hotter than we thought, maybe we'll have to hike, they're saying, we think that we're still on course, but maybe not as many cuts as we said in March. And so the markets have essentially reset back to where this initial breakdown occurred and stalled there. But where we are now at 34 basis points in the wake of this University of Michigan Consumer Confidence Survey is with a less than 50% chance of that second cut. 34 basis points gives us one standard size 25 basis point cut. And then it gives us a further 9 basis points into a second one, which is only a 36% chance that we get that second cut by the end of the year. Compare that with what was there before this consumer confidence data came out, and we were at 13 basis points out of 25, and that's a 53% chance that you get that second cut. So between Friday and today, the markets have gone to a place where the second cut was more likely than not to now less likely than not. It's a modest change, but an important one. Because what we have now ahead of us for the rest of the week is a flood of relevant inputs into this conversation. And of course, the first one is going to be a speech from Fed Chair Jerome Powell. He's going to be participating in the Foreign Bankers Association General Meeting in Amsterdam. That's coming to us overnight here, actually. And what we're going to be looking at is whether he says anything that would lead the markets to believe that the Fed is getting deeper into a higher for longer mindset. That essentially it is well within the range of possibility in the minds of Fed officials that inflation in the US in particular, because it's a different story in Europe, so the fact that they'll be talking in Europe is important. There's some room to compare and contrast in this conversation. That the situation in the US is sticky enough that the Fed may not have room to cut this year. And if that becomes the narrative that's coming out of this Powell appearance, perhaps we shift closer to 30 basis points. Maybe even into the high 20 basis point range. It's not far away. But already that would significantly change the calculus. That would then set the stage for what is probably the biggest piece of this puzzle. That comes to us on Wednesday with the US CPI report. Now, there's been some interesting movements in what's going on here. We, of course, surprised on the upside for CPI for March data, and that very clearly was very impactful for markets. They moved to really take out quite a bit of easing from the forecast, and that was a big knockback for stocks. And we may well see that here again, but the internals are really what matter. In particular, take a look at what's going on with energy. So we can see here that the contribution to overall CPI is still fundamentally stuck within what's going on in the service sector at the core, excluding energy, excluding food. The contribution from food has been essentially steady since January. It's added about 0.3 percentage points to overall CPI. The contribution from energy has been negative, as we saw the unraveling of what was essentially an energy price spike in 2022. And we can see here with the yellow bars below zero here, that's this right there, as really the place where energy was actually pulling inflation lower. Notice headline inflation bottomed just as the negative influence from energy reached a peak. And as it started to pull back and rebase out of calculations, headlines stalled. That's really been the driver for why headline disinflation has been arrested? Well, it seems to be that there's about a 1 month lag with which the change in crude oil filters into CPI. And you can see here, just as crude oil bottomed, so too did headline CPI. Note this CPI is pulled back by a month. And so you see here this lag, and you see here's the start of the recent upswell in oil, and here's the parallel perking up in headline CPI. What this is telling us is that the increase that we saw in crude oil in March, and we know, of course, subsequently it's dipped a little, but this increase is not in the inflation data yet and is probably set to show up here at the headline. The expectation is we're going to dip down from 3.5 to 3.4%, but something we saw for the first time since January of 2023 last month is a positive contribution to inflation from energy. Excuse me, since February of 2023. Correction. Between March 2023 and February of 2024, inflation was a negative contributor. Not surprisingly, that's exactly 12 months, and these are year-on-year calculations. So in March, we rolled over back into positive territory for inflation coming from the energy sector. If this relationship is going to continue, and it looks fairly ironclad here, at least near term, then we have a risk that this comes in hotter. But of course, the Fed mainly cares about the core because that's where most of the inflation lives, which is a good time to consider that March was also the highest reading for core services inflation since September of 2023. And we, of course, recall that's where the Fed got spicy on rates. That's where they last spooked the markets with hawkish myth-making. It was November, after inflation backed off, that they really started to say, well, maybe we don't need to hike rates any further. So we may be in a place here where not only is there a surprise risk on the upside for the headline, the core may not be quite as supportive as expected. The expectation is that it'll come into 3.6%, essentially reigniting disinflation after it stalled in February and March at 3.8%. 3.6 would be the lowest in 3 years. If we don't get a number that's that rosy, well, then we're getting into a situation where whether the Fed is able to do even one cut starts to come into question. Now, on top of this conversation in the US, we're also going to get some data out of China. And of course, this is the world's second largest economy. So this is always something to keep an eye on. And what we see here is industrial production and retail sales are both expected to show a bit of a pickup when we get these latest numbers. 5.4% year-on-year increase in industrial production expected, and a 3.7% increase in retail sales. Now, when we consider the industrial production side of it, that would be the strongest outcome yet this year. And if we consider the retail sales piece, it'd be a slight improvement over the 3.1% rise that we saw in March, but still relatively weak. The March increase of 3.1% was the weakest number since July of 2023. So it was a fairly substantial miss. The 4.5% rise in industrial production was the weakest since September of last year. So also a relatively significant misstep. We're expecting to see a little bit of an improvement on both scores here when we get the April data at the end of the week on Friday, except data from Citigroup seems to suggest that economic outcomes out of China have increasingly struggled relative to forecasts since about early April. So it's been about just over a month here, well, let's call it, that Chinese economic data has increasingly deteriorated relative to forecasts. What this seems to say is that economic models that generate forecasts have been rosier than is being backed by reality. And what that means is that these numbers might well miss on the downside, incidentally, just like they did when they were last updated for the prior month. Now, this is particularly worrying now because the US is also seeing aggressive deterioration in economic data over the past month. And then, of course, you get the question that we were asking ourselves last week. If the US is finally buckling, if resilience in US economic growth finally starts to give way, and the bite of higher interest rates finally and belatedly arrives relative to previous cycles, what's the safety net for the global economic growth picture? We've seen that 50% of global growth is split between the US, the Eurozone, and China, and the other 50% is mainly made up of vendor economies to the former three. Which means if those three are misfiring together, there's very little global growth at all and anywhere. The US has been the lone pocket of strength for the past year, year and a half. China has basically crawled to a standstill. And the Eurozone finally grew last month, if we look at the PMI data, after 9 months of contraction. So it is still exceedingly weak. It'll take a long, long time for the Eurozone, absent a phenomenal explosion in regional growth, to get to some sort of a setting where they could offset a US downturn. And China is nowhere near anything like that. So if the US is finally rolling over, against that backdrop, weak Chinese economic data would say, oh, well, US is rolling over and there isn't a safety net. That means global recession risk is on the table. And of course, that doesn't bode well for stocks either. Even as perhaps the Fed becomes more reluctant to cut, at least as market expectations have it. And of course, while that's probably something that bodes ill for stocks, it might very well bode well for the US dollar. Both because scope for rate cuts might be diminished, and also on risk aversion grounds. If stocks decline because the Fed appears like it's not going anywhere quickly as the global growth story starts looking scarier, capital goes to cash. And the cash of choice is the most liquid one, and that's the USD. And that is macro money for today. Thanks very much for joining. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what might happen thereafter. A little bit of a scheduling change this week. I'll be off on Wednesday, which means that my usual Wednesday appearance on The Price of Truth with Victor Jones is going to actually happen on Tuesday. And Macro Money will be off that day. We'll be back on Thursday. I'll also be on for Futures Power Hour as usual on Friday. on with Victor and Tom for First Call on Sunday, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Good luck out there. See you tomorrow.